Okay, in this video, I am going to analyze changes in sales from expected amounts. And not sure why this is discussed way down in slide 33. It's like one of the last things we cover. To me, I feel like this should be one of the first things that we talk about. And in actuality, we did talk about this already. Okay, so let's set up the scenario. Okay. For starters, I'm going to ignore the second product. Let's just look at one product, okay? Let's look at the golf balls. Exciting stuff. Okay, so we budgeted 1,000 units at $10 a unit, and then we actually sold 1,100 units at $10.50. So all else equal, it looks like our actual results exceeded our budgeted amounts. And I want to know like by how much and what's the like how much is the difference and how much relates to the fact that we sold at a higher price as opposed to how much we received because we sold more units. And so that's what this schedule is trying to attempt to articulate. And I'm just going to kind of do this on my own for a second. I'm just going to say, look, we start the process by creating a fixed budget. Okay. And the fixed budget, in terms of sales anyway, let's just talk about sales. We said, according to our slide, we're going to sell 1,000 units and we're going to sell every one for $10 a unit. And therefore our expected sales is 10,000. And so I am going to put 10,000 right here. Then we have our actual results. And our actual results was that we sold 1,100 and we sold every one for $10.50. And therefore our actual sales were 11,550. 11,550. And therefore, we exceeded our budgeted amount by 1,550. And it's a favorable variance, right? Because our budgeted amount was 10,000 and our actual sales was 11,550. And so now what we want to do is we want to say how much of the 1,550 relates to the fact that we sold more units and what portion relates to the fact that we sold at a higher price. The way that we do that, and we've already talked about it, we create a flexible budget. Okay. And a flexible budget is just going to restate the fixed budget, but with the actual number of units that we sold. And so we sold 1,100, and then we are going to keep the original price. We said that we would sell every unit for $10, and therefore our flexible budget, had we been precise on how much we sold, right, in our creating the budget, we would have assumed we would have, man, I'm getting pretty good. I'm getting pretty good because I just fucked up by clicking that stupid button that was in the middle of the screen and it ended the recording. But now I think I'm adding to what I've already recorded. Anyway, hopefully I am. Uh, okay, so the flexible budget says that we would have hit 11,000 in sales. And now we can determine what portion of this 1,550 relates to the fact that we sold more units. And we will do volume variance. And so the volume variance is going to be the flexible budget minus the fixed budget. And I'm coming up with 1,000 favorable. Then we can call this the spending variance or the price variance. Maybe I'll call it the price variance. And that is going to be 550. Again, favorable. And so now we know that we exceeded our budget by 1,550. 1,000 of it has to do with the fact that we sold more units, volume variance, and 550 relates to the fact that we sold at a higher price. That's really powerful stuff, in my opinion. And again, this is just the second product, and I don't really like that. It's just too confusing. Made 11,000.